Welcome back to ATHENASIA TV. Today, I have the pleasure to receive Mark Francis from Zetl that will discuss alternative financing for SMEs. So, you have a really interesting background, being born in Hong Kong. Can you tell us a little bit more about your story, just to tell our people
Sure.
who you are, where you come from?
Because I tell people whenever I'm born in Hong Kong, immediately they go, "Oh, so you must be, part Chinese." I'm like, actually, no, I'm not part Chinese, but I am a product of globalization, and I guess the way that the world was in, a few decades ago. So, my father came over from the UK to Hong Kong in the late '60s. He joined the civil service here in Hong Kong when they were actively recruiting in the UK. My mother was actually born in Colombo, in what was then Ceylon, an ex-British colony. And then her father was in the Merchant Navy. So he worked in some of the major ports around the world, Colombo and Calcutta being two, Jakarta, but also Hong Kong. And so their family ended up in Hong Kong in the mid-60s. They themselves were kind of Anglo-Indians, mixed. So I think for myself, we have some Sri Lankan, Indian, Swedish, Dutch, and Portuguese blood through a few generations back. But yeah, obviously born in Hong Kong. So very much third culture kid type environment. But I think for my father being British and that being kind of 50% of my background, I kind of identified more with British and went to the ESF schools here. But definitely always felt a bit more part of a more interconnected world, you could say.
And then you study in the UK as well, right?
Yeah,
Eventually.
so went to school mostly in Hong Kong. Family actually moved to Malaysia when my parents retired. So I have a younger brother. My younger brother went to secondary school in Penang in Malaysia. So we sort of lived there for a while. And then, did university in the UK. And then immediately after the UK, went to Shanghai when I was 21. Just wanted to have a new adventure, experience a city at the beginning of, rapid growth. And for me also, I think, maybe regretful that I didn't speak more Cantonese. I wanted to go and learn Mandarin and learn sort of the language of the future. So that was sort of 2006 before the World Expo. And Shanghai back then was this incredible city of rapid growth.
Yeah, you basically saw the whole city emerge, right?
When I was there was basically almost nothing in Pudong. So the east side of the Huangpu River, you had one of the high rises, but they hadn't even built the financial centers behind it yet. I was living about a 45-minute drive away from the Bund. And Shanghai is a very huge, sprawling city. But I got to experience like that energy and see what was kind of going on there. And at that time, I think Shanghai had 1/3 of the world's cranes because there was that much construction going on. There was just building everything. So it was a great experience. But I think also having grown up in Hong Kong, having experienced that balance you can get in living here. You can go and hike in a mountain, you can go sailing, you can go to beautiful beaches while also going to the city in the same day. Shanghai wasn't anything like that. You're looking at a half a day's drive to get to a beach or to get to a mountain. So it was a very different kind of experience being there.
So that's the reason you came back here?
I think so. I think when I look at it now, having reflected all these years later, I realized how special it was being in Hong Kong and having that upbringing here. And I saw still that there was opportunities, post-SARS, there was kind of a bit of a boom period that happened in sort of 2005, 2006. So I came into Hong Kong and got into...
just to get the 2008. Damn.
I got in just before it. So I just saw that the last kind of year and a half of that real bull market. And then obviously the world changed in 2008.
I have not known this. I just arrived here in 2008.
Oh,
so to me, it was like, oh yeah, that's normal.
Okay, wow.
Yeah.
Interesting. So I wonder why you picked that particular year to come to Hong Kong.
It's just, I finished my studies.
Right.
I was in Barcelona and then I just fly here to start working here.
Interesting.
And that's why it was 2008.
Yeah.
So here we are.
Yeah.
But let's talk more about you. So
Sure.
Anyway, let's go a bit into the business now. Like talk about Zetl, like what you guys are doing.
Sure.
But mostly, let's see for our audience, for them to understand a little bit, like how can alternative finance help them in their business? As an SME owner, as an entrepreneur, like. First, what it is, because even for me working in accounting, I'm sometimes when I heard trade finance or alternative financing, I'm not too sure what I could do with that.
Okay.
So I think it's really interesting to try to speak about it a bit candidly.
Sure.
So can you maybe tell us like what it is about, how it can benefit SMEs, and maybe give a case on either like the kind of audience we work with, e-commerce or consulting, trading, sourcing, something like that?
Sure. So I think if you imagine yourself as a business owner, how do you fund your business, right? Either you put in money that you've saved yourself, or you bring in external investors, in which case you would normally give them some shares in lieu of that equity capital. That's typically how you're going to start a business. You could go to a bank and try and take a bank loan, or maybe you take out a mortgage or some other kind of product to give you the capital you need to build your business. Yeah. So look, if you imagine yourself as an entrepreneur who's trying to set up a company, typically you put in your own savings or money you raise from friends and family. You might sell some shares in the business you've incorporated, which would be equity capital raising. You might try and even get a bank loan if you're able to, but it's notoriously difficult these days to get access to bank loans as an early stage entrepreneur, right? They want companies that are more of a sure bet for them. So they have relatively limited options as an SME owner. And that's kind of where a business like Zetl comes in, because we can provide financing to even companies that are only as young as 6 months old, that are looking to get access to growth or working capital to scale their business. Maybe they don't have physical assets like real estate or huge pools of inventory that they could use to put up as collateral, but they want to be able to access financing to grow their business. That's kind of where we come in. And I think also partly that was also my background. So I've been an entrepreneur for 12 years. Zetl is not the first company that I've done. The first 2 companies that I was involved in were in the HR sector, the recruitment sector. And those are both very good.
Co-working, you said also.
And a co-working space, which was a business that failed. But maybe if I had access to financing, it might not have. But there was 2 recruitment consultancies where the businesses themselves were profitable. They were good companies, but they didn't have any physical assets to post as collateral. But what they had was very good invoices with very good clients. So, think of a consultancy that, maybe you've got a 10-person privately owned consultancy business in Hong Kong. They themselves are what is considered to be a slightly high-risk investment because it's small and it hasn't got physical assets. Mm-hmm. But they could be providing services to a large bank or perhaps a global insurance business. So they'll have a service agreement with that customer, and then they'll have invoices that are either on a monthly or somewhat semi-regular basis. So what we are able to do at Zetl is take those invoices as our collateral and then provide financing to the organization using those particular invoices as that security. So yes, there is an element of risk still to what we're doing, but because of how we structured it and because of also how the tech that is available now allows us to be integrated, we can kind of get the security and guarantees that we need so that we can comfortably offer this type of financing and ensure that we get paid back on that. So that's kind of a very clear use case. For myself as an entrepreneur, as a recruitment entrepreneur, what I wanted to do was build a contractor book. And contractors, you need to pay every month, right? You have to pay your contractor every month contractually within 7 days. The issue was, and the issue is still, many of the clients that recruitment firms are working with, they don't receive payment from their clients until 60 and sometimes 90 days after delivery. So you could be in a situation where you have to pay those contractors for 1, 2, and maybe 3 months. Mm-hmm. And obviously, if you have one contractor, it might be possible. But if you've got 5 or 10 contractors, you need to find a way to pay all of those individuals if you're not receiving it from the customer. And that's when, again, a facility like Zetl comes in. We can offer a credit line secured by multiple customers, which is used to basically pay those contractors every month to ensure that you retain them and you keep them happy. And this is a model that has been replicated across dozens and dozens of firms, not just in Hong Kong, but also in Singapore, which are 2 big international financial centers that also have quite deep pools of consultancies, agencies, and these types of businesses.
And what's the name of these things? Because how do you call these?
I guess that would be called receivables financing.
Yeah. And what is the difference with factoring, for example?
Yeah,
maybe
that's a good question.
People are more aware of factoring.
Yeah, so factoring is specifically used in trade finance. So in a trade finance arrangement, you have a shipment of goods that need to go from one place to another place. And there's obviously a consignment, and there's also, again, delays in receiving payment. So what would happen in that scenario is a trade finance company comes in, they factor the invoice, which means they actually take the assignment of the invoice, or they own the invoice, and then they're responsible for ensuring that payment is then delivered from the end customer. So they, in essence, disintermediate this first company, and then they go directly to the customer. Now, what we do is something called invoice discounting. So it's a similar concept, but it is quite critically different. We use that invoice as collateral to, in essence, provide a loan to the business. we actually do not contact the end customer directly. It is a fully discretionary form of financing, confidential form of financing. And the key thing
So
is
you won't annoy the
we never
customer
annoy
of
the end
your
customer.
client.
Exactly. And in
Okay.
Asia Pacific, as you'll know, you've been here for many years, there can be an aversion to the use of debt. In some cultures, it can be considered almost a dirty word. So you don't necessarily want your customers or your suppliers to know that you're taking financing. So with a discounting arrangement, you retain that confidentiality. What are the differences? Of course, yes, the cost is slightly higher because there is more risk to the lender, so the cost will be slightly higher. But actually, with the technology that's available now, you can still find ways of getting security that we need to be able to offer this. And what's interesting is it's not just trade finance and it's not just for consulting, but realistically, digital marketing agencies, technology companies, they have a very similar pain point, and you can use this data for your financing.
Basically, as soon as you have a 60, 90 days payment or something like that with a reliable customer, this is
Correct.
This is the kind of clients you
So
could
we'll
work
want to
with.
see, the historical payments from this customer. Do they pay on time, even if it's late? We're doing an assessment on the individual customer. We're doing an assessment on the end customer. And then what we're doing is we're kind of doing a somewhat of a credit arbitrage where you're getting kind of a high yield return from the smaller company, but secured against an investment grade quality credit. And what's great is even though we're lending to small businesses, the customers are typically listed companies and multinational corporations, and sometimes even the government. We've lent against the Hong Kong and Singapore governments before. So the issue is not that they're going to pay. I mean, they could theoretically not pay, but then the world is in bigger trouble. It's just that they're slow and they're late and administration mistakes happen. Surprisingly quite common.
Yeah. I'm also wondering, can you also help with LCs, like a letter of credits? Because I
Interesting.
know it's a bit of a pain for people to get LCs in Hong Kong. It's not really easy, and a lot of customers are used to LCs back in Europe, India, Middle East, and then when they come to Hong Kong, they want to use LCs. It seems the infrastructure doesn't seem to be there.
Yeah, it's again that's more related to trade finance. To be perfectly honest with you, we've seen cases like this before. Purchase order financing, letter of credit financing. I would say it's not our forte, if I'm being perfectly honest with you. And I think in Asia Pacific, again, it's not quite a developed form of financing in this part of the world. As you said, in Europe, it's very common. Organizations will tend to offer this product, but it's less common in this part of the world. So we've come across it, but to be perfectly honest, it's not something that we ourselves are looking to offer so much these days. We're focusing on sort of the asset light and services sector market, and also we do work with some e-commerce businesses and even some F&B retail hospitality as well.
How can you help the e-commerce, for example? Because a lot of our audience and clients are actually e-commerce.
So this is, again, sort of what technology allows us to do is we can get integrations now with payments processors, with POS vendors, and even some marketplaces, online marketplaces. So
like Amazon or Etsy.
not necessarily Amazon, but similar companies to these, or Shopify or Shopline. So what in essence happens is we can integrate with these companies through API. We get access to the transaction data in an anonymized data set. So it just goes company A, B, C, D, E. You don't know who the company is, but we can use that data to train our credit model. And then we can use that to come up with a sort of a credit rating, but also we can offer two major products. One is we can offer an instant cash settlement payout. So I'll give you an example. Let's say you go to an e-commerce store and a consumer sees this business. They use their Visa or MasterCard to make a purchase through the store. Now, Visa is a great example. They actually don't make settlement for up to 14 days. So there is a very natural payment gap there from when the transaction has been made to when the payment is actually received by the payments processor or POS vendor. So we can, in essence, take that data set and then allow the merchants of that platform, the e-commerce merchants on that platform, to withdraw their funds pretty much immediately if they wish. So it can be, T+5, T+7, or T+9, something like that, which means that you get access to all of that capital immediately without having to wait for that sort of up to 14-day payment gap. Similarly to that, we can then even actually offer what's called a merchant cash advance, which is a loan for all intents and purposes. And again, we're using that same transaction data, coming up with an assumption on this business, and then we can maybe offer that business 1, 2, or maybe 3 months of the average sales turnover that they have. That's a facility they can draw down today. And then what happens is they are paying us that back over a number of months, and we're collecting from the payments processor and the POS vendor directly. So it's good for that end merchant because they get access to financing immediately. And it's good for us because we're actually claiming it back from the partner, the intermediary, rather than the end customer.
Application case for that, for example, if you sell something that's seasonal and you know that you have a lot of orders, let's say November, December for Christmas, then you can
Christmas, Black Friday, Black Monday, I think it's called. There's all these different days.
It's the whole area, like November, December. Exactly. You see the e-commerce sales just go to the
and roof. Actually, maybe also you need financing during the low months to ensure you can pay all of your staff and your rent and your other costs. And then conversely, when you know that there's going to be an uptick in business, you have to be able to make sure you have enough inventory, and then you need the financing to obviously purchase that ahead of time. So those are probably the main two use cases, right? The growth capital and then the working capital use case. Yeah.
Okay. And how much does it cost to use this kind of service?
Yeah. So look, where there are a number of lenders out there. If you take money from a bank, there tends to be a lot of hidden fees. For us, it's very transparent, and we're very open about that. So we have two costs. One is an admin fee charged at the beginning of the contract. The admin fee can vary, but that is done one time. And then there's the monthly interest rate. And the monthly interest rate is depending on what interest rates are at the moment. Obviously, rates have been higher the last 2 years than they were in the preceding few years. But the signs that rates are going to come down later this year, we also then will drop our rates in line with that. So that's very clear, just two charges that we are.
More or less at the moment?
I would say for the admin fee, circa 2% of the value of the financing. For the monthly interest rate, circa 1.5% a month or so. But that should come down.
Okay, cool. Yes, anything you want to add on that I didn't ask for? Or?
I think, in terms of the business and the product, hopefully that's pretty clear. We are a tech-enabled lender, right? So for us, the idea is using APIs, using all of its transaction data. We have a machine learning algorithm that is the credit model built in-house, which is some of the proprietary tech that we own. We can also use open banking APIs to see bank statement data in real time, so we can verify information that's been shared with us. We can do things like electronic direct debits now. So traditionally, if you wanted to do an EDDA, you had to fill in a form at the bank, submit the form at the bank, and wait a couple of weeks for that to be approved. Now you can do it all online seamlessly, and it's approved within a single day. So that means also then when it comes to the administrative side of repayments, we can do that ourselves. We literally can just automate payments every month at a pre-agreed cap and just take out that money until the loan has been repaid. So what we're trying to do is reduce the amount of manual work that's involved for the customers, but of course also for us internally.
Okay, and you are based in Hong Kong, but do you serve people outside the territory?
Yeah, so we have been now live for 5 years. We launched in Hong Kong and Singapore concurrently. We actually launched in both cities at the same time because they had a lot of similarities in terms of population, large service sector economy, a lot of service sector firms there, and very similar kind of common law jurisdictions as well. So we have two other co-founders, myself, another one, Shan, in Hong Kong, and then Matt in Singapore. So when we launched, we were already a distributed business, and we launched with customers in both locations. And then since then, about 2 years ago, we expanded into Malaysia and then the Philippines, and we've also lent to companies in Australia. So at the moment, we're active in 5 markets. For this year, we are looking to continue that expansion. So expect to see us in probably another 1 to 2 markets in the region, but very much all in APAC. We are an APAC lender.
Okay, mostly APAC. Okay. Yeah. Okay, cool. So there's one thing I like to do when I'm receiving people on the podcast, because most of the people are entrepreneurs, and most of the people watching us are either entrepreneurs or
maybe want to be
entrepreneurs,
Yeah.
So basically, what would be your 1, 2, 3 tips you would give to somebody that wants to start with entrepreneurship?
Yeah, that's a very good question. I think the first one is you need to come into it with your eyes open. You need to be aware of the risks for any entrepreneur. 90% of startups do fail within the first few years. It is a high risk thing to do. So what you need to think about is, have I made up maybe enough savings from the job that I have currently? Do I have a safety net perhaps for my partner or my family? Maybe my government has also welfare nets that are there. Do you have some kind of protection just in case things do not work out?
Or do I have
which
never work out.
Well, this is very common. And then even if it does do well, you are going to go through so many hoops. Even to have a business that is successful, there was always going to be so many hoops. And I say this as somebody who's been running companies for 12 years. There's constantly things to deal with. We all just came out of COVID, and that was a real shock to the system. So I would say come in with your eyes open, really be prepared for that. Make sure you've established what would be the safety net for yourself, whatever that looks like. Two, this is probably more of a personal thing. But I think it's relevant to many, and it really depends on your personality style. I've always had co-founders. In anything I've ever done, I've always had one, if not two, co-founders. Again, it might be better suited to individuals that enjoy working with others, that are very collaborative in nature. But I think the benefits of it are, having somebody that you can bounce ideas off and brainstorm with, being able to have somebody that can share the dark and difficult times with you too, who understands what you're going through, because actually the whole is greater than the sum of its parts, and you can support each other. So anything I've ever done, I've always had one or two co-founders, and of course, you have to make sure you give up the right amount of equity. They have to have skin in the game. They have to be motivated. So that's something that is a personal choice, but I would say it's one way to perhaps ensure success.
It's a fun tip, because one of my tip is don't get partners.
Right. Interesting.
Because as working in the accounting side, what I can see is that so many people that come with partners just
founders disputes happen.
They dispute all the time, like 99% of the time.
That's why I said it's a personality choice.
So I'm really surprised you come up with this. I understand the synergy, like you come with all the positive aspect of partnering. For me, I can see all the negative one, and I'm like, oh, that's an interesting.
I think also maybe for me personally, I think you need to have a certain amount of introspection and self-reflection. What are your strengths and what are your weaknesses? Are there individuals that can maybe complement those strengths or support the weaknesses perhaps that you have? And that's where perhaps I've seen the benefit that's come in over the years. Founders disputes will happen. Yes, of course, and that's something that I guess can lead to the breakup of a business as well. So that's why, like I said, I think it's dependent on your personality style. What is a match? It doesn't work for everybody. Some people do need to do things independently. And of course, now you also have mentors, which is not necessarily a co-founder, but a mentor can also fulfill that function. Somebody that can be a sounding board to help you through the difficult times. So that's maybe what I would say. If you're not necessarily a co-founder then, but a mentor or some other individual that you can perhaps collaborate with.
What about a good employee that you treat well and pay well? What do you think?
Possibly, but then that employee needs to also be incentivized. So maybe there needs to be a way that they can be accelerated up to more of a leadership or managerial type position. Perhaps also they could fulfill that function as well. But yeah, it's interesting that you would say that. And of course, you see that. Maybe I'm talking from my personal experience. The third one, and I think this is again more relevant for the last couple of years, is if you're going to set up a business now, you need a clear path to profitability. You've got to know when you're going to get profitable, because if you're seeking external capital now, whether that's from VCs or family offices or even as angel investors, when we set up the business, 5-6 years ago, investors were in a very different economy. We had 0% interest rates. Money was cheap and readily available. You could take a risk and take a punt on a business and wait 5, 6, 7 years for them to reach profitability. Now, investors want to see you get profitable within the first few years. They need to know that you've got a real plan to get there within 3 years, call it. And that's hard.
It makes sense. The goal of a business is not to go raise money and then waste it for 10 years.
Exactly. We've seen so many examples of businesses that just raise money for the sake of it at ridiculous valuations, 20, 30 time revenue multiples. And you look at the unit economics, and these businesses are never going to be profitable. So you think, where does this end? And I think that's what the last 2 years has shown us. There's been a bit of a shock to the economy that was kind of needed to sort of shake it out of its stupor. And now it's a case of we need a real business with a clear plan, how we're going to get profitable. And then if you can get a business to profitability, you have options. You can take investment, you can do a sale, you can maybe look to list if you're big enough. And that's really what all entrepreneurs should be thinking of now.
Yeah, I'm 100% agreeing.
Yeah.
Okay, well, I think that was a really nice podcast.
I enjoyed it.
I enjoyed it as well. I learned a lot as well from you. So thanks for coming. I hope you guys enjoy as well. If you did, please, if you're still there, congratulations first. Second, you can press the like and subscribe to the channel for more podcasts in the future. So thank you, Mark.
Cheers.
And,
all the best.
All the best.
See you guys.